You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Buyers and sellers of loans operate in a market with much less transparency and liquidity than the markets for treasuries or mortgage-backed securities, creating space for intermediaries that can effectively connect different parties and accurately price loans that have their own set of unique characteristics. Like many financial markets during the last few years, the market for loans has changed through high inflation, Fed tightening, and now the start of Fed easing. On today's episode, we talk with Mitchell Redd, Senior Vice President with the Capital Assets Group at FHN Financial, about bridging the gap between buyers and sellers of loans, how investors are viewing lingering concerns over commercial real estate, and how the beginning of Fed rate cuts will impact the loan market. Stay tuned. Coming up soon, our interview with Mitchell Redd, but first, a quick market update. The September employment report this morning showed the unemployment rate fell from 4.2% to 4.1%, while payrolls growth rose from 159,000 to 254,000. Treasury yields rose 8 to 12 basis points across the curve on the perception that labor market improvement will lead to a more cautious approach from the Fed when it comes to future policy easing. Fed funds futures are now fully pricing in a 25 basis point rate cut at the next Fed meeting, though there will be another CPI report and employment report released before that meeting. Yields otherwise stayed within relatively narrow ranges the last 2 weeks, with 10-year treasuries anchored close to 375 and 30-year treasuries maintaining resistance just above 4% and support close to 4.15%. The BEA's annual revisions to historical national accounts data last week showed higher economic growth during the last few years than previously reported, especially in the BEA's gross domestic income data. The upward revisions suggest household savings have been much higher, a meaningful shift that provides a solid foundation for future personal spending. Also last week, the core PCE deflator rose only 0.1%, a notch below the consensus expectation for 0.2%, and solid confirmation that the Fed's preferred inflation metric is on a path to a 2% annualized rate. Outside the economic data and market developments, a number of external shocks recalibrated market pricing in terms of geopolitical risks and inflation expectations. Hurricane Helene devastated areas of the southeast, particularly in the western part of North Carolina. Widespread dock worker strikes along the U.S. East Coast threatened to congest ports and slow down supply chains, but a deal was struck to extend the current contract through January 15th after only 3 days of strikes. Also this week, Iran fired 200 ballistic missiles towards Israel, increasing the possibility that Israel's fight against Hamas will escalate into a much wider regional conflict. Crude oil prices rose, and the total inflationary impacts of all these shocks are still up in the air. That's all for the market update this time. Now our interview with Mitchell Redd. Our guest today is Mitchell Redd, Senior Vice President with the Capital Assets Group at FHN Financial. Mitchell, thanks for coming on the podcast.
Will, thanks so much for having me.
Now, Mitchell, walk us through what the Capital Assets Group does. How does the service you provide differ from other intermediaries in the financial services industry that buy and sell, say, securities?
So the Capital Assets Group is basically the loan analysis and trading group for FHN Financial. We've been around for 35 plus years, starting in the late 1980s. And there's two big things that we do as part of our business. The first is we provide a lot of proprietary loan analysis to help financial institutions maximize the long-term performance of their loan portfolios. So try to help them look at their loan portfolio the same way they would at their fixed income or investment portfolio, looking at things like liquidity value, interest rate risk, credit layering, prepayment speeds, collateral risk, that sort of thing, taking a broader view of the overall investment performance of the loan portfolio rather than just the credit performance, as a lot of institutions tend to do. The second thing we do is we execute loan trades for institutions, whether that's on the buy side or the sell side. Those transactions are usually because the institution has an overall strategic objective that they are trying to achieve, and executing a loan purchase or a loan sale will help them get closer to that strategic goal that they're trying to achieve.
So to help kind of put this in perspective, I think about, let's say, the market for a 10-year Treasury, which is very liquid, very transparent. If I'm a buyer and I want to find a seller or vice versa, it's really not that difficult out there. But the way you described that for loans, the service you provide for buying and selling loans, are you kind of this matchmaker between institutions that are looking to buy a loan or sell a loan?
That's right. We're the intermediary and in touch with both buyers and sellers through our fixed income network that we've got here at FHN. And so, yes, a lot of the fixed income universe has been automated over time. And so it's a little bit easier to execute a trade. On a loan trade, there are a whole lot of other pieces and parts to it that you don't have in a fixed income security. Things like servicing associated with the loan, what the documentation of the loan is like, what the overall makeup of the loan or pool of loans that an institution is trying to buy or sell. And so there's a lot that goes into the process of figuring out which loans are marketable and which ones are secondary market eligible. And then how do you go about providing an efficient price for that specific group of loans? And so there's general guidelines as to how you go about putting it together, but every transaction is a little bit different. They may appeal to one institution in one case, but a different pool of loans might not be of interest because of the overall makeup of it.
Who are the typical buyers and sellers in these transactions that are looking to your know-how and your kind of ability to facilitate these transactions?
Yeah, so that's a good question. Well, let me start by kind of defining first two different overall types of transactions that you've got. One is associated with new originations, and the easiest way to think about that is residential mortgage loans that are sold to Fannie and Freddie at origination. They're sold one at a time. Most everybody's got a mortgage associated with their house. In many cases, that institution is sold at origination by whoever the originator is. You also see that on some commercial real estate loans where they might be selling a loan to an insurance company right after it's been originated. The other type is seasoned portfolio loans. So that would be an example where a bank or credit union has originated auto loans or residential mortgages in their portfolio. They intended to just hold it until that loan matures, but for whatever strategic reason, they decide they need to sell some loans. Those tend to be seasoned because they've been on the balance sheet for a year, 2 years, 3 years, and they might pool those up into what we would call a bulk trade. So those are the different types of trades you got, but the types of buyers that you have is typically another depository institution. So if a bank wants to sell a package of residential mortgages, typically the buyer for that's going to be another bank. If a credit union says, I need to sell a pool of auto loans, the buyer for that is going to be another credit union. Now, what we've seen here over the last 12 to 18 months is a lot of non-depositories have entered the market for whole loans. You typically, historically, only seen that with insurance companies on commercial real estate loans, but those institutions are getting much more interested in all different product types. So we're seeing insurance companies, money managers, private equity funds, aggregators that are looking to pool loans and securitize them. They're seeing an opportunity here with higher yields, with tighter liquidity in the depository institution space, and they're looking to get involved in purchasing either seasoned loans from a bank or credit union for investment or securitization, or getting more involved into originating new loans and being purchasers of those new originations for them to hold for investment.
Now, a lot of those loans that you've mentioned, like commercial real estate or auto loans, they're very complex. They're very different, unlike, let's say, the homogeneity of a 5-year Treasury note, where the terms are really all the same no matter what 5-year Treasury note, given a certain coupon rate, they're all going to be the same. And so when it comes to pricing those loans, do you use sophisticated models that try to come up with a fair price? Is there back and forth bargaining between the buyers and sellers that you've matched? Can you take us behind the scenes of how you price these loans?
It kind of depends on the pool of loans and the method by which we sell them, but we're generally using the fixed income market and securities as sort of a starting place for how we model the loans and come up with a price and then eventually negotiate that price with the investors. But to give an example, so let's look at residential mortgages. When we're pricing up a pool of mortgages for an institution to consider selling, what we'll do is we'll look to risk-free mortgage-backed securities and see where a comparable term and coupon security is trading in terms of yield. And so if that yield is 5.5%, let's say in the current market, we will typically add some additional spread or yield to that securities yield in order to compensate the investor for the lack of liquidity that you're going to have in a loan pool versus a security, as well as the credit risk that the institution is taking. So in that example, if the risk-free mortgage-backed security is a 5.5% yield, we may sell the loan pool at a yield to the investor of somewhere between 6.5 to 6.75%, depending on the makeup of that pool. And if it's a real clean pool of loans where the FICO scores are very high, the LTVs are low, the yield might be on the low end of that. If it's lower to middling FICO scores and, not elevated LTVs, but mid-range, then you're going to be a little bit wider. And so we start with that risk-free index, and then you add additional yield to it so that the investors are compensated for a loan pool versus a securities pool. And it's similar to that for other product types. Auto loans, for example, you're usually using the 2-year Treasury as your risk-free rate because those have short duration and they usually pay off within a couple of years. When you get into some product types like commercial real estate, the process is kind of the same in terms of using a risk-free rate, but sometimes there might be a credit component. So in a standard pool of residential mortgages that are good credit, the credit risk is kind of built into that additional spread. Whereas if it's commercial real estate loan or any other kind of loan for that matter that may be credit challenged, let's say, a buyer is going to want to look at it and say, well, there's higher potential for loss here. And so I need to be compensated for that greater risk. So in addition to the interest rate part of the methodology, they might add some additional credit spread, if you will. So in this case, they might say, well, I need a 9% yield instead of a 6.75% yield in order to compensate for that additional credit risk that we're taking. And in terms of, lastly, sort of how is that negotiated? On consumer type loans, the residential mortgages, the autos, we can kind of tell where the market is going to be within a certain range. There may be a little negotiation depending on a buyer's acts for loans, what they like or don't like about a specific pool in terms of the loan and borrower makeup, but it's pretty on point. When you get into more negotiation is when you're putting something out for bid and saying, give me your best price on this pool of loans, as opposed to an offer where you're offering it a set price. You'll have a lot of negotiation on those when you're putting them out for bid, because a lot can go into it of do you need to sell every loan, or is it only some of the loans? What's their cost of capital? That sort of thing that goes into the process of figuring out what the exact price is that you can negotiate in a bidding process.
All that information is really helpful to describe the kind of landscape for this type of buying and selling. I'm curious, though, to put it into more of a dynamic perspective. It feels like we've lived through multiple business cycles the last few years, and so I want to understand how the loan sale markets change depending on the macro environment. So to start things off, can you take us behind the scenes of what the loan sale market was like in the spring of 2020 or in those first few months of the pandemic? Were a lot of these institutions just freezing all of their transactions? Were they ready to unload anything at fire sale prices? What was going on then?
That's a good question. A lot of things froze up, and I'll use the residential mortgage space as the best example. A lot of that purchase activity is driven by the securitization market. And so, given where we were in the interest rate cycle, there was a significant amount leading up to the pandemic. And so, aggregators had begun to pool up loans for securitization. In the fixed income market, when the pandemic hit, kind of froze up. And so investors in securitizations backed away, which meant the aggregators, the people that were pooling those mortgages together to sell, weren't able to buy as many, or they had to stop buying any new ones. And so everything just sort of stopped. And it took a couple of months for things to unfreeze. An example of how things froze up was the seasoned agency bulk window. Fannie and Freddie used to buy seasoned loans from banks and thrifts and credit unions, but they stopped buying them because the private securitization market froze up, and a lot of these large aggregators then tried to sell billions of dollars in these seasoned mortgages through the agency window, and they weren't able to, and the agencies weren't going to be able to take on that much, so they suspended purchases of originations. After a few months, what happened is the securitization markets kind of unfroze, and you started seeing more originations in the residential mortgage market, lots of institutions being able to refinance mortgages for borrowers out there because of the much lower interest rates. And so it didn't take too long before the residential mortgage market sort of found its footing and was able to get back to origination levels that were records, higher levels of new originations that anybody had ever seen because of the low rates and sort of the investors and securitizations coming back to the market.
The next big subchapter, so to speak, of the economy the last few years, I think, started in March 2022 when the Fed started its rapid tightening that ended with what is hopefully its last rate hike in July of 2023. And they have been on pause ever since. And we're recording this just at the end of August 2024. But during that period, what were the primary things impacting the loan sale markets over those just over 2 years? How were those institutions finding value in the kind of services you're talking about when interest rates were going up, and for a while there, it wasn't clear where the terminal rate was going to be?
That's right. So it changed pretty significantly when the Fed started to give clear indications they were going to raise rates and started boosting the Fed funds rate. And what we saw was, with longer term interest rates starting to go up, in addition to the Fed raising rates at the short end of the curve, values started going down more and more and more. Nobody knew where we were going to stop. And so it impacted sellers from the perspective of loans that they had originated, held on balance sheet, were all of a sudden worth less than they had been. They were originated in a much lower rate environment. And so those coupons that they had on balance sheet that they thought they could have sold at par or a premium to par were now going to be worth much less. And as interest rates kept going up, buyers were kind of backing away because they said, I don't want to catch a falling sword and buy a loan today that's going to be worth less tomorrow. It felt a little bit like when you buy a new car and you drive it off the parking lot and they say it's worth $5,000 less as soon as you get out of the dealer's parking lot. And so buyers started to back away, and sellers wanted to sell to get some security and to lower their interest rate risk on their portfolio, because a lot of what they had originated and held on balance sheet was fixed rate, or at least had a longer duration associated with it. But they didn't want to sell at a loss, and the buyers were starting to back away. The other big thing that happened a little over a year later was in the spring of 2023, when Silicon Valley Bank failed. What we saw then was a bank that seemed perfectly good one day, that all the depositors sort of electronically walked out the door the next day, and the bank failed. And so institutions around the country, banks, credit unions, everything, started to feel additional pressure, not just from rising deposit costs because rates had gone up and their interest rate margins, debt interest margins, were getting compressed, but all of a sudden depositors were actually leaving. And that was something that hadn't happened in a while. And so liquidity got very restricted in the system. And so even if a seller said, I want to sell and I'll sell at a discount and take the loss on it, a lot of the buyers just said, I can't buy anymore because I don't have the liquidity. I've got to hold on to every piece of liquidity that I've got to manage new customers. I'm not going to be able to allocate liquidity to purchasing new loans. And so it kind of, the loan market sort of froze up starting in the spring of 2023 because of that drain of liquidity and drain of deposits. that was sort of the final piece, if you will, of rising interest rates that they were getting pressed on starting in 2022. What we're seeing in 2024 now is it's starting to unfreeze a little bit. I think a lot of the liquidity shock has gone, but it's still somewhat constrained. But we're seeing buyers, at least on the depository side, start to come back to the market and be interested in purchasing pools of secondary market mortgages, autos, HELOCs, other product types.
Something that I think also picked up steam in the spring of last year after Silicon Valley Bank failed were these worries about commercial real estate, that because of this transition during the pandemic, that property valuations were a lot lower in a lot of places, and they were up for maturity where they would have to reinvest at much higher interest rates. From your perspective, how are buyers and lenders viewing CRE right now? Are they still worried? Do they feel the worst has passed? Is it too hard to tell? Is it just a big foggy cloud where no one really wants to touch it?
That's a really good question. I'm not sure there's a perfect answer to it. It varies a lot between institution, depends on geography of that institution, the location of the properties, and the specific product types. And so the ones we hear the most about and see the most about in the Wall Street Journal and other places within the commercial real estate sector is office space. And that's driven a lot by pandemic. And so work from home became a big thing. And people started moving away from downtown areas, learned that they didn't have to commute as much. And so that's where we see and hear about, and it feels most tangible, is office properties having problems as a result of the pandemic and people not coming back to the office, even though institutions are trying to get more employees back to the office. They don't have to, so they've scaled down the space that they have, or they're moving out of other properties. There was a good article just this week on Bloomberg about a $557 billion drop in office values. It gets to the point that, within markets, especially some of the larger metropolitan areas around the country, New York, Chicago, LA, about they're having problems, but they're not necessarily broad-based in all of those markets. If you go to downtown LA, you're seeing significant problems with occupancy and properties going into bankruptcies or selling at 50% of their prior values. But you can go to other suburban markets in LA or Dallas, for example, and you've got robust occupancy levels, prices, values that have maybe gone down a little bit, but not nearly as significantly. A lot of it just depends as it relates to banks primarily that are holding commercial real estate loans. I think it varies. I know that a lot of institutions are feeling pressure from investors and from regulators, especially if they have significant concentrations in commercial real estate. You've seen some articles, S&P, Wall Street Journal, Bloomberg, about institutions that have higher concentrations of commercial real estate trading at lower levels than others because there's an expectation that even if there might not be credit problems today, that there may be tomorrow. And the reason they aren't necessarily today is they're performing okay, but the loans they've got out on those properties might be at a 4% coupon. But when their hybrid period ends or their balloon period ends and their rates reset to higher levels, those borrowers are going to get a lot more squeezed. Their financials are going to get a lot more squeezed. And so the question is, how are some of these at-risk properties, whether it's office properties, multifamily, or anything else, going to perform when the borrowers are having to pay an interest rate that's 50 to 75% higher than it is today? You don't see all that many problems in the depository space. You see some. Delinquencies are up. I think you're seeing charge-offs up a little bit, but it's not dramatic yet. The question is, as we get into the next couple of years, what's going to happen? And if rates come down enough by the Fed, if the Fed lowers rates enough, and we've got time that's sort of moving in that direction, to some of these problems get solved. Or if we go into a recession, does that compound the problems? And so we're kind of in a hazy period right now. You're starting to see defaults on some big properties in some big cities. On a broad based, it just kind of depends a lot, like I said, on the product type. Office is unfavorable, but you've got plenty of office spaces that are good. You've got other different product types like multifamily, storage, industrial, hospitality, that sort of thing within the commercial real estate that I think are still viewed pretty favorably, but it just kind of depends and varies from location to location. And that's kind of always been the story with real estate is location's the most important thing. And that seems like what's driving a lot of it these days. And then just kind of the waiting game associated with how much and how quickly is the Fed going to change rates.
I want to talk more about that period where the Fed does start to lower rates. We're talking now before the Fed's September 18th meeting, but based on Chair Powell's Jackson Hole speech and the macroeconomic data, that first rate cut certainly feels more within reach than it has been in a long time. So with the Fed on the precipice of easing, how are you looking at a falling rate environment? How do you think the buyers and sellers that you typically work with will change their behavior, change their approach in a falling rate environment?
Yeah, so I think it'll definitely increase activity, and we're beginning to see a lot of that these days. So institutions that we do regular analysis for are calling us saying, hey, we might be more interested in selling loans. Do we have some that are more, I'll call it in the money or closer to being in the money, where they can either take a small loss versus a big loss, or they may trade at something closer to par. And so more of the would-be sellers who just wouldn't sell over the last couple of years because of a valuation perspective, rates coming down lifts the values of those outstanding loans. And so from the seller perspective, it makes it, they're more interested in doing a deal where it's not going to have a big loss associated with it. Buyers, I think, will feel more comfortable in a lower rate environment as rates move lower, that if they buy a loan, that it is going to retain its value or increase in value with lower rates. And so they're going to feel more comfortable. And as rates come down, I don't think we're going to see a big refinance wave, but I think the liquidity situation will ease a little bit because you'll start to see some early payoffs of loans, some refinancing of loans, and it frees up liquidity for institutions to go out and make new loans or to purchase loans. And so I think it will increase activity. We've started seeing more of that in specific loan types during the year. Short duration assets like auto loans have been easier to put together trades that makes sense for the seller and buyer because there's more content in the portfolio of newly originated loans that have on-market coupons. It has been slower in the residential mortgage market, for example, because so many people's portfolios are weighed down by these fixed-rate mortgages from 2020 and 2021, where the coupons are still pretty significantly underwater. But generally speaking, I think that lower rate environment, especially one where it's probably going to be incremental as opposed to a big drop down all at one time like we saw at the beginning of the pandemic, I think that's favorable to the market for both buyers and sellers. So we'll see activity increase because it'll be a little bit easier to match up those buyers and sellers at prices that make sense for both.
You talked about the advantages or kind of the scenarios where an institution would want to sell some of these loans, where they could find value in it. Are there alternatives to loan sales when they find themselves in those situations? How do you see other options in those circumstances?
We talked to institutions about a number of different things, and there are investors that have different options that are available to just a sale. One example might be if somebody's concerned, a depository institution is concerned about their net interest margin, about what impact falling rates is going to have on their portfolio. Executing an interest rate hedge might be something that could work for floating rate assets or loans that they have where they could lock in a fixed rate. And so their net interest margin would have more protection in a lower rate environment. Another option that we've seen a lot and a lot of investors are participating in that's been targeted at different assets or what we'll call credit risk transfers or synthetic risk transfers. You'll hear them referred to as CRT transactions or SRT transactions. And it's basically taking a pool of loans and not necessarily doing a securitization, but splitting up the cash flows similar to that, where the investor would assume a certain amount of losses on the portfolio at a fixed price that they're charging the institution to do that. What they accomplish with it is they get better regulatory capital treatment because those assets would have a lower risk weighting because another investor is assuming the credit loss associated with that transaction. And so it helps them from a capital standpoint, and it also helps them from an asset quality standpoint because they're being relieved of some of the potential losses of the portfolio. Now, what works other than a loan sale kind of depends on what your overall strategic objective is, or whatever the bank or credit union or other investor, whatever their objective is. If the primary factor is I need more liquidity, a loan sale is still going to be the best option. But if there are other things that you're trying to achieve related to net interest margin or capital or credit quality or something else, then some of these other options might make sense. But in the market that we've been in, with constrained liquidity, liquidity's been king for institutions. And so the best way to solve that problem is with a loan or other asset sale to get more liquidity.
We've been speaking really at a kind of conceptual level, which has been really helpful to understand everything that goes on. But do you have any concrete examples of recently completed trades just to better understand all of these mechanics? Recently completed trades that are good examples of good loans trading at price efficient levels where having this intermediary between buyers and sellers is really clear.
Yeah, I'll give you a couple of different things, some examples. So in the credit union space, I mentioned auto loans that have traded a lot. So that's one where it's been easier to make something work because auto originations kind of kept up at a good pace, even with interest rates going up, because people were trading in cars and need new cars. It's not impacted as much like the residential loan market. And so institutions that are big originators of autos might say, I need to sell a pool of $50 million in auto loans. Credit unions that have more liquidity in recent months are looking to invest in something that's got a shorter duration associated with it. It doesn't have the interest rate risk that maybe a 30-year fixed rate mortgage. And so we've seen a significant number of auto and other consumer loans that are short duration, high coupon, be able to trade between credit union, for example, or that might have been sold to a securitizer that may be able to sell it. So it's a good example of the type of trade that get done. One in the commercial real estate space that we worked on specifically over the last few months was a multifamily trade. So we had an institution that had purchased another bank, and they were going to have a pretty significant concentration in multifamily loans after the merger was done, and said, I need to sell some of these multifamily loans in order to get some liquidity, be able to reinvest in some other loans, that sort of thing. And so we worked with them and eventually ended up settling on a $2.8 billion trade of multifamily mortgages that were sold to a partnership of Bank of America and PIMCO. So it was an aggregator, a bank with a balance sheet, an aggregator, and a money manager that was very interested in investing in the commercial real estate space. Now, these loans were sold at a discount, but when you calculated what was the investor yield associated with the purchase of those loans, the yield was very comparable to where a borrower could go out and borrow on a new loan. So it was very comparable to where the market was at that specific time. And so it was a very good transaction for the selling institution because they were able to sell loans at market rates without a big credit discount. And the buyer felt really good about the credit quality of the portfolio and were willing to pay kind of a tight yield in order to get those loans. And so it was a win-win for all institutions. The timing was good. The selling institution now has a significant amount of liquidity available to it. It's got less of a concentration in commercial real estate, and it works. It worked partially because it was part of a merger and the accounting associated with mergers but that's the type of deal that can work. We identified the best assets that we felt were prime grade and then worked with investors to negotiate which subset of loans would be the best to purchase and give the selling institution a good return on that specific pool of loans.
Mitchell Redd, thanks for coming on the podcast.
Thank you so much, Will. I appreciate it.
That was Mitchell Redd, Senior Vice President with the Capital Assets Group at FHN Financial. The way that Mitchell described buyer skepticism towards adding loans to the portfolios during the early stages of Fed tightening is a really interesting echo to what we saw with institutions' approach to treasuries and other securities over the last few years. The fear of rising rates and depreciating asset values kept buyers on the sidelines, and even though rates are heading lower now, the market will thaw only incrementally rather than all at once. The September CPI next week will be the last before the Fed's November 7th meeting, with market participants and Fed officials increasingly confident that inflation is on a sustained path to 2%, the focus has shifted to the labor market, so this report may not have the weight that it's had during the last few years. That being said, a low print could sway FOMC participants who are on the fence about how aggressively to cut rates in order to support the labor market. Fed Governor Chris Waller even mentioned a couple weeks ago that his support for the 50 basis point cut in September was from a worry that inflation would fall too far. We'll also see the minutes from that September meeting next Wednesday. Investors hope to get a sense of what the discussions were like within the FOMC before opting for a somewhat surprising 50 basis point rate cut rather than a more timid 25 basis points. The minutes could give clarity on how the Fed's reaction function perceives the current state of the labor market, which would then give hints about future decisions. The following week, September retail sales will close out third quarter consumer spending data before the advanced third quarter GDP release towards the end of October. The Atlanta Fed's GDP Now tracker currently estimates 2.5% overall growth, with personal consumption growing 3%. A number of Fed speakers are scheduled to speak over the next 2 weeks, though we see no appearances from Chair Powell on the calendar. Officials could use these opportunities to articulate how recent data, like this morning's employment report or the September CPI, have or have not impacted their views on the macroeconomy. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.